Welcome back to Real Estate Simplified. Lori, assignment sales have been a hot topic as inventory has been incredibly low and people are looking for any opportunity out there to get a home. So first of all, if somebody's not familiar, what is an assignment sale in the first place?
Right, so as you mentioned, I'm seeing a lot more transactions of this nature lately. And essentially, you may have purchased a pre-construction home, house, condo, whatever property that makes sense for you and your situation. And perhaps your situation has changed. As you know, pre-construction, you're purchasing in advance of...
Sometimes well in advance, we're talking years.
I've seen 7 years to get a condo built. So it really depends, and obviously a lot can happen in that time frame. You may have gotten a job elsewhere, you may not even be living in that city. You may have had a family and just can't fit into your one bedroom anymore. So lots of different things, lots of different reasons why. And you basically, if you have it written into your contract that you have the ability to essentially sell your right to purchase that home, usually before you close on it. So in this case, you would never actually close on the property and live there, but you're transferring your right to buy that property. And so the new purchaser, if you will close on the property.
Yeah, and there's also people who will, take a contract with the builder with more of a speculative approach and then assign that before closing. But how are assignments treated when it comes to taxes? Because that's a totally different animal.
Right, and so to your point of you may be a speculator, you may have never intended to live in this property, and that's going to be treated a little bit different than if you were planning to live there and have that be your principal residence. So what's really interesting is that the CRA takes the position that it's based on what was your intent at the time you initially purchased. And so you might think, why does the CRA care what I'm going to do? It's none of their business. But actually that's what drives the taxation. So there's two different types of, tax that could apply. One would be capital gain treatment, which most people are familiar with when you sell appreciated assets. And one would be just an ordinary business income type treatment. And those differ because capital gains is favorable, and everyone might be familiar with that. It's taxed at 50% of your ordinary rate. So most purchasers and then sellers of these contracts would prefer the capital gain treatment, but the majority of these contracts are treated as investments or speculative investments and are taxed at the ordinary business income rates.
Yeah, we had a client where it was a condo and she had purchased it years and years and years ago. She had time to get married and have 2 kids by the time it was finished, and then she actually assigned the contract to somebody else. So in that case, it was treated as a primary residence transaction because her intent was to live there. Mm-hmm. So how can an assignment qualify as a principal residence for the exemption?
Right, so I guess 2 things to look at. So one, getting back into the capital gains treatment, which everyone wants, if it was your intent at the time to live there, and there's sort of evidence that you would need to provide to support that, because the CRA is going to try and steer you in the direction that it wasn't your intent.
Of course.
And the onus is on you to provide that evidence, whatever that might be. So maybe you didn't own any other properties, maybe you haven't participated in any assignment sales before, you're not a flipper of real estate, and really the circumstances fit that this would be where you'd live. You could then potentially qualify for the capital gains tax treatment. However, because you don't ever move in to the property and reside there, you do not get to take advantage of the principal residence exemption. So there will be some tax no matter what with an assignment sale.
Yeah. And, what are some things people should be aware of when it comes to timing? Because with taxes, timing is sometimes a lot of it.
Yeah.
What should people be looking out for?
Yeah, so I think definitely, speak to your professional advisors about this and maybe have them review your contract once it's drafted. Some of the things that I've been seeing from a timing perspective would be that the way the contract is written, you are not receiving the fee, your assignment fee, if you want to call it that, or your profit, until the new buyer actually closes on the property, when they have the chance to obtain a mortgage and get financing for that. So where that can be problematic is if, let's say, you assigned your right to purchase in September of 2021, but the property is not scheduled to be built until June, September of 2022, something like that. The assignment is taxable when the assignment is considered to be transferred, which was in 2021. So you have an income inclusion in 2021, but you don't have any proceeds until 2022. So you're going to be paying that tax ahead of when you actually receive the funds. So something to be aware of. There are some mechanisms in the Tax Act that you could potentially use if it's capital gains treatment. If it's not, that could be really problematic. So I think wording of the contract's important. When you receive the proceeds is going to be important. If you can time those to be in the same year, or just ensure that you're receiving the proceeds at the time, or just be aware of it so that you know.
Exactly, and with some of these larger properties, the cash flow hit can be quite substantial if you're paying a good chunk of tax when you don't have anything coming in for it until the next year.
Yeah, and I've seen some recently where, the homeowner or potential homeowner purchased the property a year ago, 13 months later needs to assign it because they're moving, and with a $200,000 profit from it. So the assignment fee was $200,000. So that's substantial tax.
Yeah, definitely. Now, how does HST factor into all of this? Because a lot of people are familiar with the resale market, where HST is typically not applicable, but when we're in new construction, HST does play a role. So what do we have to watch out for there?
Yeah, so HST can be a little bit tricky, and again, it's really going to be dependent on the wording in your contract. It's also going to come down potentially to the intent, the intent at the time. In terms of what the end game is on the HST front. So I think something to be aware of is generally new construction is subject to HST. And we're speaking about individuals here where there's sometimes some exemptions or rebates and things. But, from a corporate perspective, there's always going to be HST in these situations. So I think depending on how the wording of the contract, and the one that I just mentioned with the $200,000 profit, that was a specific real world example that I saw. It's just, there's no HST being paid by that assignee. It's just included in that assignment fee. Mm-hmm. So you're going to be subject to remit the HST on top of that $200,000. The new buyer is not paying that over to you. So just something to be aware of that can really eat into your profit.
Yeah, and I think with assignments, a lot of people think it sounds like a good idea. Oh, hey, we're just selling pieces of paper, but you have to really realize the tax implications, and oftentimes the profit you were expecting isn't really there because it goes to taxes.
Yeah, exactly.
Yeah, and speaking of taxes, the last thing anybody wants is a CRA audit. Mm-hmm. Does doing assignments or the assignment process, does that raise any red flags with CRA?
I wouldn't say necessarily red flags, but it's definitely a hot topic right now, obviously with a lot of appreciation with real estate across Canada and specifically in the GTA. The CRA has hired, additional workforce to be able to look at those that are engaging in flipping properties and sort of any real estate transactions. I think it's sort of the hot button issue for the CRA right now. So it is more of a focus. I know certain provinces have actually put systems in place to be able to track assignment sales. Not in Ontario yet, but I suspect that that's coming. So it's definitely something to watch out for. Certainly talk to your advisors, make sure you're doing the proper reporting and you have the evidence to support your intent and I guess therefore the tax treatment.
Yeah, exactly. And if CRA were to audit, what would they focus on? What should you be saving? Should be all of that sort of stuff.
Yeah, and that's tricky. And I think it's case by case. It's really, there's no sort of overall general thing that works here. It's because it comes down to intent. So I guess evidence of, where you lived at the time that you purchased the property, what your situation was, could you financially afford the property or financially afford to close on the property. Sometimes if you're just flipping them, you don't ever need to obtain the mortgage and the financing for that. I think if your job situation is relatively stable, there's a variety of different pieces of evidence that you can have, and it's just whatever you think you can use to prove that your situation, what it was at that time. Certainly save any receipts or invoices that pertain to the contract, so legal fees that you needed to pay, those may be deductible against the profit, any consulting fees potentially, any accounting fees, maybe in some cases you could deduct the fees you paid to your accountant. Certainly any real estate commission that you needed to pay should be deductible. So just ensure that you're saving all of those invoices and just give everything to your accountant and have them go through and see what might be deductible for you.
Yeah, no, good stuff. Definitely a lot to think about with assignments.
Yeah.
So stay tuned. Coming up after the break, we'll be talking about incorporation and how that affects financing.